Good day, fellow investors. Today we're going to talk about something more important than stocks, especially more important than stock prices, but not commonly discussed. And that is portfolio strategy. And the best way to discuss that is to really give you one of my portfolios as an example of strategy, of performance, of what are the goals, of how investing goes, and what is investing inherently for me. To do that, I want to go through key investing concepts as I explain the portfolio, the performance, the goals, the strategy, to really discuss what investing is, compounding, risk, how when stocks go up unintuitively, it is not good. When stocks go down, if you are an investor, it is likely better for you. If stocks go up, then your longer-term returns are unfortunately lower. That's also a difficult concept to understand alongside compounding, so I really think this is the video that will give you the most value for wealth accumulation over the long term, so please smash that like button for channel support. Thank you. So let's immediately start with my model portfolio. In 2018, in May, I started with my stock market research platform where I wanted to share the details of my analysis and especially share it with serious investors. That's why it is a premium subscription. That's how I feel better doing it. In order to show what I do, to really have skin in the game, I said I'll start one portfolio alongside the start of the platform, that I'll start with 10,000 and I invest 1,000 on a monthly basis. And I'm planning to do that for another 17 years at least. I might start a new one then so that we close this cycle, but the plan is for the portfolio to have a target of 20 years. This is something that first discusses investing over the very long term, constantly adding, which is the biggest value you can give to your financial life. The total money invested that I put into the portfolio was, as said, 10,000 at the start and 36,000 over 3 years, logically. That is now 46,000 that I have put in. And that's also something key. First, when it comes to investing, the fundamental is the income and the money you put in so that you can gain benefits in the future and over the very long term. That is investing, renouncing something now to gain benefit in the future. But the start is, of course, saving. If you don't save, if you don't do that, then you have nothing to invest. And of course, you want to do something with that money that you have invested. And my goal for the model portfolio is to achieve a return of 12% per year, which I think is possible, and then reach $1 million in 20 years. For that, the starting 10,000, the total contributions of 12,000 per year, and I should be with invested $250,000. With 12%, I should be at $1 million, somewhere around $1 million in the next 17 years, as I'm already 3 years in. So the first concept of investing is saving and actually investing, because that is what really creates the fundamentals. There are so many people, especially now on YouTube, gambling with 1,000 here, with 2,000 here. I recently received an email from a person, this is my $2,000 portfolio, what do you suggest with 20 positions? Well, I suggested to, as the English language was perfect, to get an online job, to start doing 1,000 per month and add to that portfolio. Nothing to say about the position. So first mindset, first step seems so obvious, but not many are doing that, is investing, and especially investing through thick and thin. Because when you do that, when you start investing as an automation, then you allow for long-term compounding. And long-term compounding, if you compare the total contributions with the future value at a 12% return, so when it starts compounding, when it starts gaining interest on interest, you can see that with 12% you start to feel a difference somewhere around year 9 or 10. That is why compounding is such a difficult concept to understand. Then over 15, 17, 20 years it really starts to kick in. But you have to do things diligently, think about risk, not lose money, as Buffett says, and then you allow for the magic of compounding. Of course, it depends on returns, and you can play around with the investor government compound interest calculator. So we have started with 10,000, the monthly contributions are 1,000, plan for 20 years, estimated interest rate 12%, and if we calculate the thing, we can see here how contributions and things don't diverge much, but they really start diverging year 10 especially, and then more and more. The key is obviously to contribute each year over time. Given what's going on with the stock market, you contribute more when things crash, and then you do much better. Now let's talk about performance. And if I look at my portfolio now, every transaction, whenever I do, 15-20 minutes later I send an email. So a lot of people who follow that, who like that strategy for their portfolio, and now the portfolio value is about 66,000 something as I'm doing this video. You can see here I have 4 key positions, not much diversification, or because I think it's diversification. When I find something good, something that fits my targets and risk appetite, then I put my money there. That also is what usually makes the difference over the long term. As said, 66,000, and if I put this into the calculator, 12% per year over 3 years, I should be at 54,000. As I am 64,000, I am at 24.6% per year. If I continue like this, then let me put here 24.6. Let's calculate this. And if I continue like this, then my 20-year return will not be 1 million, but 4.7 million. It could happen, doesn't have to happen. It will depend on a lot of things in the future, but we'll see. We'll certainly strive to do this, to do better than expected. And now 95% of my stock market research platform members are extremely happy with the performance, so 24% per year, that's amazing over 3 years, and the structure of the portfolio is made so that it might continue with double digits over the long term. But that's not something to be happy about. That's not something good, because keep in mind the strategy of the portfolio. The strategy of the portfolio is to keep investing into businesses for the next 17 years. So if the stock prices go up, which means that the 1,000 that I will invest usually around the 20th of the month, thus next week, the 1,000 that I will invest will have to pay a higher price for what I am buying. If that price would be 50% lower, I would be able to buy double of the business rather than the stock prices are higher when I have to, what I have to pay now. So the concept of being happy when stocks go up is not rational from an investing perspective. We should all be happy if the value of this portfolio would be now at around 30,000, so that I invested 46,000, business and everything all equal, the dividend yield would then be perhaps 20 something percent over the next years, which means that I would be able to reinvest, buy more of the businesses, and over the long term create even more wealth. So that's the rational thinking. Looking at stocks going up, everybody feels good, the ego is pumped up, but that's not investing. So it's difficult to explain. But don't be happy when your stock goes up, especially if you are younger and the population of this YouTube channel is, let's say, all young. So we should not be happy, especially YouTube. Everyone is happy with stocks going higher. Nobody should be happy with stocks going higher. All that we should beg for is stocks going down and staying there for 20 years. Then in 20 to 25, everything exploding 10x, that would be the best. But this is about investing. And why I'm talking about investing and speculating? Because investing and the core of my portfolio is about investing in businesses, owning businesses. So what is real investing? What creates investment returns? And how do we measure risks? Those are key questions that we have to answer. Because we did a video about Baidu 2 weeks ago, and now the stock price is a little bit down, and I get so many questions now. Is it still value? Sven, the stock is crashing. You recommended it. No. I made an analysis, as I do a lot, also this YouTube channel, so you have the public list on my platform, you have the premium list. I analyzed Baidu as a business and said that with what's going on, it is, let's say, fairly priced, in this case for a return slightly below 10%, which is a great return. 8, 9, 10% is a great return. Then I explained the business, and you have to see how it fits your portfolio. However, when it comes to stock prices, the stock, especially if you look over the last year, can go up from 100, can go up to 330, 40, then down to 200, and from here I have no idea where will the stock go. I'm looking at businesses. Do you want to own the business? And that is investing. And from Baidu, it's likely that the business return with the ups and downs will be around 9-10% from the current price. However, there are also better buys there. If we look at Alibaba, then it's very cheap for a 10% return. We are talking about higher returns there, and there are many other businesses depending on valuations and expectations. But the key is that 98% of people invest in stocks. Look at stocks going up and down, getting excited when it goes up, which is not investing. Investing is about owning and accumulating businesses and deriving your investment returns from those earnings, from those businesses developed. If we look at the S&P 500, the earnings of the S&P 500 expressed in points were around 90, 95 in 2007. Then those grew to 160, and now we are at 140 points. This gives a price-earnings ratio of about 40 compared to the current price. Or if we look at the long-term cyclically adjusted price-earnings ratio that takes into account 10 years of earnings, we are still high at 37. It was much lower 2009, of course, but this is one reason why the stock price went up, because the valuations went from 5, 6 in 1982 to 40, so 6x. 6x over 40 years is one of the biggest reasons why stocks increased. And now you can always play on those valuations, but that is speculating, and that's what most people do. Look at, this is undervalued, this is overvalued compared to a relative thing. I'm looking at businesses, earnings, dividends, cash flows, business growth, where will be the position of the business 3, 5, 10 years down the road. And then, when I found a business I like owning that gives me the likelihood of a 10 to 15% return, sometimes even 20% from a business perspective, then I invest into that. And that's my goal also for the portfolio. Looking at businesses that will do good over time with double-digit returns. So I'm not gaining or losing from stock market prices going up and down. I can take advantage of that, but the core business return and the difference compared to the S&P 500 is earnings, dividends, cash flows versus valuations. That's my added value, I think. And you can see here, added value, I don't do diversification, I do focused investing, good businesses that I like, that I think the business position is so that it will reward me over time. And then if stocks go up, okay, sometimes you say, okay, now this is a little bit overvalued from a business perspective. There is this that is equally, let's say, valued as a business, but much cheaper as a stock. And then you might switch to that one for better long-term returns. But here the returns will depend on the market. I always look for those 10 to 20% business returns. When the market starts agreeing with me, then they push it to 5% returns, they push the stock price higher, as we said, the returns go lower, then I might compare and switch to something else. But if nothing happens with the stock price, or the stock market closes for 10 years, I'm happy owning those businesses just for the dividends that will come over the next 5-10 years. Or if there are no dividends, that's also possible, the growth in business that will evolve over time. That's business investing, and that gives you much more safety and certainty when it comes to investing. So my goal is to do 10-12%, and then whether it will be 24, 25, 20, 40% per year, that will depend on how the market goes up and down, how the market sees my positions. That's something I can't predict. What I can predict is business growth with a degree of certainty, dividends, cash flows, reinvesting those, and then manage the investment around that. So my message is always align your investments with your investment goals. What are your investment goals? If your investment goals are, oh, I have to do something with this money and let's play a little bit in the stock market like most people are doing, then you are not a real investor, and we don't have much to chat about if you don't want to learn more about investing. The next step when it comes to investing is risk. My portfolio, and I hope so, can crash 50% tomorrow. If the businesses are not affected, that would be a blessing because I could buy more easily and increase the return, increase the wealth of the portfolio over the long term. But that's not risk. For me, risk is business risk. So what do those values depend on? Long-term business development or supply and demand? So I don't do those gambling stocks like cryptocurrencies or something. Anything can happen there, but that's not something I do. That's not how I want to structure my portfolio. I want a portfolio that has good earnings and good business positions, etc., etc. So I hope these investing concepts really help you out in thinking in an investing way, long-term way, and especially remove the addiction that people have with stock prices going up. It's all about stocks, this, but actually investing is about the core business and what you get from that business over time from being an owner. That's my message. This is what we do on this channel. Don't forget to check my stock market research platform. All the researches, all the portfolios are there. 28-day money-back guarantee, so feel free to check that out and see whether you want to build wealth with us over the long term. Thank you, and I'll see you in the next video.